TJ the Wheel Joe coming at you live with a special episode of Talking Options. Picked up the phone call my buddy over here, and I was like, I need a little help. So he usually takes my phone call, so here we are. And then we ended up turning it into a stream for you guys because he's going to educate me a little bit today on the wide, wonderful world of put credit spreads, and we might even talk about call credit spreads a little bit. How are you, Option?
Good. How you doing, man? How you doing?
Doing good, man. We got a Wheeler seminar today, and we're really going to sink our teeth into put credit spreads and then my backstop trade. Don't need any help on the backstop trade. That's my bread and butter. But I want to make sure that I'm not misinforming the audience tonight. You follow me? Because I want to make, I know that they work for me, and I feel like I have like my strategy kind of like down pat for what works for me. But I want to show you two examples of put credit spreads that I have going on right now. And I would like for you to give me a constructive critique.
Okay.
Because there's your tasty trade. You know, for those of y'all that don't know, if you want to give a little bit about your background on how you followed the tasty trade methodologies, if you will.
Absolutely. And we all trade, right? We all have our way of trading. But
right.
What I like about them is that they give you a foundation. Now, they don't say you actually have to do it the exact way, but they give you the foundation to be more creative and be able to create your own strategies around what you know. So that's pretty much how I do it. And then, so now I use a lot of their foundation, but then I create my own around it.
Absolutely. So let me talk to you about the put credit spread, the one that I did. So for those of y'all that are not familiar with put credit spreads, tune in tonight, but I'm going to give y'all like a little prequel this morning. So essentially, whenever a stock is trading at a range that I'm not really excited about it, but I feel like I'm monitoring it, I'm stocking that stock, if you will. I want to ring the cash register because it's still taking up some of my time. So put credit spreads is kind of my go-to move whenever I'm like stocking a stock that isn't really in my desired price range right now, to where I just want to tie up all this capital and sell the cash secured put. The stock might just be too expensive for the portfolio, or it might just be too expensive where it's trading from a valuation perspective for me. And two of those stocks that fit that particular criteria for me are Meta and Palantir. So I decided to utilize the put credit spread strategy, where you sell a short put and you buy a long put as some insurance. So it's a defined risk strategy. And I wanted to ring the cash register. And the reason they appealed to me is because the ROI is a lot higher than a traditional cash secured put, and you don't have to tie up all of this capital up front. Now, with my idea, in my mind, the way that it works is like, when the shit goes against me, and if it goes to 590, and now this thing gets challenged, well, now I'm kind of sitting up in my chair because now I'm really interested in potentially turning this into either I can just roll it and manage it that way. You just take a bath and take the loss. We're not going to do that.
Yeah.
Or I could turn them into bona fide cash secured puts because now I'm interested at 590 again. You know what I mean? Like, I'm not interested at all at 673. But I wanted to talk to you about the dynamics of it. So did these on 124. So you can look on the chart on your side and see where Meta was trading when I did these. And the expiration was for 2.7. So it's a 15 wide spread, and collected a total of $255 in credit, so $2,550 for tying up this collateral. So what say you? What would you have done differently? And do you understand where my mindset was? Because just in basic arithmetic, using basic arithmetic, I'm like, I'm gonna tie up 15 grand for about 2 weeks. And you're going to pay me $2,550 just to position myself to actually be interested in this trade. You follow me? Because if the shit goes down, that's actually good news for me, because now I can go to my wheelhouse, which is managing cash secured puts, because I have the capital, because it would be $590,000 that I would need to close the long put out, because that's the insurance policy on the trade. I'll make money there, and then I'll manage to 590, maybe roll it to 575. And then I'm interested in taking ownership of Meta at 575. The mindset, take it away.
All right. Like I say, we all do it different, right? We all have our way of doing it. And it just depends on how detailed you want to be with it. Me personally, I don't do the weeklies, right? I kind of stay away from the weeklies because of the bid-ask spread. They're a little bit wider in the weeklies in opposed to the monthly. So if I was going to do that, I would have done it in, Feb 21, which would have been the monthly, because the bid-ask spread would have been a little bit tighter.
Mm-hmm.
And now that we not just doing one leg, we're adding on a leg. Outside of that, the next thing is the amount of money that I'm going to take in, right?
Okay.
So I would have at least had to have taken in $5 for that $15 wide spread. Remember, we always speak the third of the width.
So it's a third of the width of the spread. So the only way for me to do that is it would probably have to be more like a 590, 585 or 595,
Yeah.
580.
Yeah, so you probably would have had to have came closer. But me, my start is the 30 delta, right? I always start with my short put at the 30 delta. So that's how I technically set it up. And from there, if I go out with my long put to see where I'm, how much I'm gonna get. So if I start at the 30 delta and
so what I want to do is I'm gonna create this example as you're talking it through. That way it makes a little bit more sense for the audience. Fair enough. So what you're saying is you would like to go to the 30-day cycle. So February the 28th.
Well, if you want to go shorter, you can go to the 23rd, February 21st if you want to, because that's a monthly too.
Okay, so that in this third week of the month, so this is going to have the most action anyway.
Mm-hmm.
So, and you're going to go 30 delta, so you're probably going to be over here in the $600 range. I bet that's going to be around the 30 delta.
That's where I'm going to start at. Yep, I'm automatically starting my short.
Probably going to be 620. No, I'm still wrong. 630. Damn,
30 delta is when there's
probably about 640. Right here, 640. So what you're saying is you're going to be pretty close. See, so right away our philosophies are different because you're essentially treating this like you would a cash secured put. Because if this is a bona fide cash secured put for me, that's probably where I would be selling the cash secured put and managing it accordingly. So you're that aggressive with your short strike on the put credit spread.
Well, that's initially, right? Because I want to see how much credit I'm gonna take. So if I'm gonna do a 15-point wide, if you go up 15, then I will see where my credit is. Okay. So if you're at the 640 and you go 640,
625,
25, and I'm gonna see, okay, well, I'm gonna take in 458, right? Okay. Yeah, I can't go. That's a little less than the $5, but right there, I'm gonna have to stay at that strike. I can't get no lesser than that, right? I have to. Unfortunately, I'm gonna have to stay there, because I got to get close to $5. I just have to.
Yeah, because if we do your example here, where we sell the 640 and buy even the 630, that's bringing in 314. And then it's a $10 wide. So that is giving you that third of the width.
Yeah, around the third. Yeah.
Interesting.
So if you do 10, 15, it all depends. Now, as the sometimes it just depends on the volatility at that moment, because you can get further away if your volatility, is high, which in Meta, the IVR is 50. But at the same time, the implied volatility is low, right?
Yeah. So for those of y'all that he's talking about, IVR is IB rank, and 50 is kind of like middle of the road. Anything over 80 is considered extremely high. I deal with stocks that are like the implied volatility is essentially the expected move of the underlying, and they typically go on an annual basis. So that's why whenever you sell short dated options, theoretically the pendulum shouldn't swing as much because there's not as much time on the clock. But when you do a long dated option, that's why it's like, holy shit, they're paying me a lot of money. Well, it's because the pendulum's swinging like that, and you have to pick a strike price there, and that's a little bit more dangerous. So it stands to reason that they should pay you more to take on that kind of risk.
And then in Meta, the implied volatility is right within the 30s and the 40s. So it ain't extremely high. Right. So that's why you have to get a little bit closer. But even though it has a high IV rank, you can manipulate it. So for me, that's where I'm gonna start. I have to start there because I'm already picking up low deltas,
right?
Because the implied volatility is low. You're only getting like 6 deltas for that trade, right?
No, I hear you. So before we keep going with the coaching, if you will, what do you think about the philosophy overall of picking strike prices that are so far out of the money that if they actually get challenged, now you're interested because you can legitimately turn it into a cash secured put? Mind you, I'm doing these with the mindset that I have the capital. I didn't have to mess around with the put credit spread, but Meta's not at a price that's attractive to me. So I don't want to position myself at areas because at 630 it's still not attractive to me. At 590 it's kind of attractive to me. You know what I mean? And it's really like 550 is where I would be like, okay, well let's take a real position in Meta at that point.
Well, I mean, but you could do the same thing at that point too, because you have to think about that long put that you buying so far out, the delta, right? It's not going to pick up that much, right? Because see, you got some stocks that if you look at the skew, they risk is to the upside. Meta skew, the risk is to the upside, not the downside. So
you're talking about call skew versus put skew.
Yeah. So as it drop, it's not going to make, that put isn't going to pick up as much as if it was going up, if it was a call going to the upside. So, me, like I said, you might have you'll go out further, pick up some credit, be able to expand the position, but the deltas is going to be so low that you're going to just be in the trade forever. And as it start to go down against you, then it's gonna your losses pick up pretty fast. So that's why for me, I don't I would choose overall to get a little bit closer, and if I get the move, I can get out faster. And that's the philosophy for the put the credit spreads, right? You want to get a contraction in the volatility, and if you get that move, there you go, you profitable. And if you don't have to take the shares, then why take them?
So right. Where do you go to find whether or not it has, because skew is essentially sentiment, right? So the skew, a positive skew means that there's more calls than puts, guys. I try to keep shit simple on the channel, often, you know that.
Well, yeah. Well,
so when it has a put skew, that means that the fund managers, the market makers are betting that the stock's going to go down versus up. So where do you find that information? Is that on Tasty Trades?
You can find it on your platform. So my understanding and how I look at the skew is, you can say, for instance, you can go to the 51 day, right?
Okay.
And you can start at the 670. Let's say you go from the 670 to the 630. You can see that 630 is going for $19. I'm talking about Meta in the 51 day.
Yes, I'm looking at it. So are you looking at sell call, buy call, sell put? Which one are you looking at?
The put on
the sell put.
Yep, the 630 sell put. That's going for $19 dollars. Okay. Right? And then you can say, okay, you can go from 670 up 40.
Okay.
710, right? And you can see that particular call is going for $26.
The call. So now I'm going to go buy call. Is that what you're saying?
Sell call, yeah.
Sell call, sorry. Okay. Yeah.
Now that call
$43.
$26, right? So that's telling you that, and it's just theoretical, that the risk is projected to the upside, right? Because that means you're going to pay more for calls. And if you take that risk of selling it, you're going to get more. So when I look at that, it's not going to sway the trade or anything, but it just gives you a little information on, okay, where is the market kind of being priced at?
So this is what I do. This is what I do. And tell me whether or not there's something here option. This is the way that I was taught to do it. Whether or not you think the sentiment is positive or negative on the stock, is you go at the money. Mm-hmm. You go at the money. And you look at sell call, and you look at a 30-day moving average, the 30-day cycle, and you go like literally like right here. This is at the money, so that's about a 53 delta. Yeah, and that one's paying 34. You see that? Mm-hmm. So then now you go sell put, and you're going to be like right there at the money, and that one is paying 30. Mm-hmm. But so because the call is paying you more than the put, you know what I'm saying? Like, it seems like it's got a positive sentiment because they're willing to basically say, hey, if you have these shares and you're willing to put them up for sale, we're going to pay you a lot more money than agreeing to buy these shares right at the money. So to me, like, you can just deduce from there very quickly that this thing has positive sentiment tied to it. Whereas when the trend is going sideways, you're going to see that the covered calls don't pay as much as the at the money cash secured puts.
But you know what that really just tells you when you do that? It just tells you that that's what the expected move is for that cycle, right? So that's all that kind of tells you.
But if you do this for different cycles, you're going to probably start seeing the same trend.
Yeah,
if you go to that 51-day cycle,
move is.
If we go to the 51-day cycle and we're right at the money, it's 30. And this works better. This works better whenever, like, if this was at like 670, 250. You follow me? Mm-hmm. So it's not really aligned perfectly there either, just to call a spade a spade. Yeah. So if we really wanted to use this cycle, we would use the 680 versus like the 670, give or take. So the 680 put or the 670 put is paying 35, and then the 680 call is paying 38. So it's still skewed to the upside because you have the same variance you have the same distance from the current share price to the strike price is about $5 away, but yet they'll pay you more money on the covered call side versus the cash secured put side. You follow me?
Yeah, I mean it's all the same, right? It's really all the same, or it depends on, like I say, how one looks at it, right? Yeah, but the main thing around that is to let you know that that's where the risk is being projected, whether it's to the upside or the downside. But from that, that's how I will construct my trade.
Sure.
Right. So if I know that my risk is to the upside, what is that telling me? That if the market drops, you're not going to make as much money going down in opposed to if it went up.
Yeah.
So if you're selling that put credit spread, to me, I have to be aggressive on that.
Yeah.
Right? Because if I go too far out, man, it's going to hurt me. That short call, that short put is going to get murdered.
Right.
It's going to get murdered. And the long put is not really it's not gonna pick up that much to be able to offset, the loss. So now you having to manage that position, and I'm not really I don't think we should have to do that.
Yeah, because when I sell put credit spreads, guys, I'm playing it very timidly, if you will, as opposed to when, like, y'all see me sell cash secured puts, I'm extremely aggressive. But with put credit spreads, it's like I literally do trades that, like, I don't even have to look at, because I feel like there's nothing that can happen right now, short of like China invading Taiwan or something, that would cause Meta to drop to those levels, right? In my opinion. But that being said, I think this is a really worthy discussion option, because it shows people that there are options and different ways of playing this thing. Like, to me, when I do a put credit spread that's so far out of the money, because that's exactly what it is, make no mistake about it, it's because I don't want to manage it. And I was just like, okay, if I'm going to tie up 15 grand, you're going to pay me $25.50 just to put it on my radar. I'm good with that. But you utilize it as more of an income strategy and cash flow generating strategy. So you're like, well, I could get a lot more out of that. And if the market sentiment's good, you'd have probably been doing these things at like 630, 620 or something like that.
Yeah, but I mean, TJ, you got to get paid for your risk, right?
Yeah.
And that's my thing. It's not no way that I'm trying to do it, but I have to get paid for the risk that I'm taking. You see what I'm saying?
For sure.
So now it allows me to be able to manage it better. So if I'm doing a $15 line, I'm getting $5. That means I'm paying 2 to 1, right? Yeah. I'm risking 2 to make 1, right? But if I go out too far, now I'm risking more to get less.
Yeah.
Less. So now when it's time to defend that trade, I go to the other side to defend. So if my short put get tested or I get into the middle, then I immediately start selling the other side to reduce, right? Because you got to be able to reduce your loss if you wind up having to get a loss. It's just the way that it is. Now you can take ownership, you can do whatever you want to do, but at the end of the day, you have to be able to reduce your losses or reduce how much you are losing, right? So that's why I have to be aggressive so I can get paid. So if it doesn't go my way, I can reduce my loss, I can manage it, I can do different things, right? Because at the end, regardless, you know, you want to be able to pay less for the shares than opposed to, you know, not being able to pay less. So that's how I kind of attack it. You know,
I hear you. Well, let's look at another one, because grilling and drilling is practice makes permanent. You know what I'm saying?
Absolutely.
It won't make perfect. Perfect practice will make perfect, but practice makes permanent. So my baseball coach used to tell me anyway. So I did another one. Probably screwed the pooch on these two, but we'll see, right? So I did the 65/60s on Palantir, and I picked 65 because that's the area that I would like halfway be interested in again. 60 is really the area that I'm interested in. I just feel like Palantir has just gone on a moonshot, and half of the move is justified, the other half is not, in my opinion, right? That's why I sold the shares at $79 and didn't look back. But I kept stocking the stock a little bit, so I wanted to get paid. So in 123, I sold the 65s option, and I bought the 60s for the same expiration date at 2/7.
2/7.
And so I'm gonna look at it here. So we tied up. And
which one you did again?
65 and the 60. Sold the 65, bought the 60 for 2/7. So I tied up 20. And again, this is just the way my little brain works, right? I tied up $25,000 for a couple of weeks, and I brought in $3,350. So in my mind was like, sign me up, right? Because you take the 3,350 divided into the 25 grand, and I'm like, dude, I'm doing great. But then when I talk to you, and you're like, no, you got to get a third of the width of the spread. So essentially, what you're saying is I need to bring in like $7,000 or $8,000 for the juice to be worth the squeeze.
Yeah, because if you figure you got a $5 wide, and this, if you had placed it that position right now, you got a $5 wide, and you only taking in 63 cents, right? So yeah, you can be able to, you know, add on, you know, 20 contracts, but it doesn't take away the fact that you're only getting 63 cents. You know,
yeah, I got 67. I got 67 cents when I did it.
You know what I'm saying? So I mean,
so I had to do 50 contracts to generate a decent.
Exactly. And I mean, now like I said, everybody trades different, and there's nothing wrong in, you know. But see, I don't look at it to that extent. I'm not scared if the stock go down, right? I don't care if you come back to me because I know how to defend it, right?
Yeah.
So that's why the first thing I do, I will expand the $5 wide because your deltas are too close. You see what I'm saying? Because you figure that's a 14 delta, that the 65 is a 14 delta, the 60 is a 7. So that's too close for me. So I would move that to at least a $10 to $15 wide. So if it comes back, then you can just roll that short put to the next cycle.
Okay, so then I'm interested in doing more. So this is why I have you on here. So if option is going to sell some put credit spreads on Palantir right now, what are you doing so that I can just do them and call life good?
All right. So for me,
so like in other words, my whole thing is I'll let you take the reins on this trade, and then I'll watch the video after, and I'll try to understand what your mind was.
Okay. So now, if I was coming to Palantir, right?
Yeah.
Like I said,
so what would we do? Let me go here. Palantir, forget about the one that I did. I feel good about it. So that's important. But what put credit spreads would you do? And I'll put them on, and then we'll see how it goes.
Okay. Now, the first thing is I would do put credit spreads in here is because 2 reasons. It got a high IVR, which is at 94, and it has the implied volatility is high. So that means you're
because earnings is in a week.
On the 3rd. But you know, we don't worry about that, right? I don't that shit don't bother. Oh, excuse me. I don't because I don't know what it's.
Hold on, I gotta go get my cap since we're doing the put. Hold on.
So let me look at it. 51.
Since we're doing put credit spreads on Palantir, I gotta put on the Palantir hat. You know what I'm saying?
Yeah.
Okay, go ahead.
Now, but what I will do is, being that I know that it is earnings, I'm gonna give myself a little bit more time. right?
Okay, go
I'm gonna
ahead.
give myself a little bit more time, so I'm gonna go to the 51 day,
Okay.
right? So the first thing I'm gonna do is, like I say, I always hit my 30 delta. That's just formality. I just do that so I can see exactly how much I'm gonna get.
So your 30 delta is probably going to be over here in the 70, I bet.
It's gonna be the 70 put.
Okay, so you're going to sell this guy. Okay.
And then I will go to the 60 put and buy that.
Okay, so now let's walk through it, and then we'll do 25 contracts.
Oh, not now, not now.
No, but I'm just saying we're gonna talk about it. Okay, so now there it is. That's what it looks like. Okay. So now you're tying up 20. Oh, I like this. So you're tying up 25 grand, and now it pays you 6,500. You see how those numbers are a lot different than the one I did, guys? Holy shit!
Yeah, but that's still not enough for me, because remember,
okay.
I have to at least get about over $3.
So what you're saying is you're a real greedy bastard when you sell cash security.
I just have to get paid for my risk, right? So if the third, if I know I need a third, which is, that's just how I'm gonna do it. I might have
about 800. It's about 8 grand. It's about 8 grand is what you're looking for.
Yeah, I might have to come to the 75.
Okay, damn. Okay.
Yeah, I have to. I mean, now I'm getting paid for my risk.
Now, wouldn't you make
75, 65?
Hold on, hear me out. Wouldn't you make more money though, or the same type of money as if you spent less on the insurance and you just widen the spread, so you can keep your lower delta on the on the short put? Couldn't you buy the 55 instead, and wouldn't that give you more money? No,
it's not gonna. Yeah, it's not gonna be no difference. It's gonna give you actually less. So what I would do is go to the 65, 70.
So 70. So you sell this. You sell the 75. The 75. Okay, hold on. Let me do this all over again. Hold on, I screwed it all up. Give me a second.
Okay.
So we're gonna go trade options, sell put, and then now you're basically saying your team Palantir, you think they're gonna knock it out of the park on earnings, and you don't care. And you're gonna sell this guy right here, and then you're gonna buy which one?
The 65.
So you're gonna buy this guy right here. So you go.
Now I'm getting paid.
And then now we're gonna go 25 contracts again. And let's just see what the math looks like, right? So review order. So now, holy shit. Okay, so now we tied up 25 grand, but you got almost $9,000.
See, now I'm getting paid for the risk that I'm taking.
Right? I hear you. So now walk me through, how do you manage it? What is the mindset? Because I don't get me wrong, I'll do it because I don't give a shit from the standpoint of worst case scenarios to define risk strategy. What does that mean? I'll lose 25 grand minus the credits that you took in, right? That's the worst case scenario, right?
Okay.
So I'm like, okay, cool. How do you manage it? What is the mindset when you go into this thing
and want to manage it?
Knowing that you're not really interested in Palantir at 75. So turning it into a regular cash secure put at 75, you feel like you kind of knew better than that because you're familiar with the stock. And I'm talking about me because I'm very familiar with the stock. Like, it wouldn't surprise me if this thing had a 60 handle on it after earnings.
Okay, well, see, for me, how I will manage that, right? If that's my position, the first thing I do, I know where my break even at. My break even is around 71, right? That's where I'm gonna break even at, right? So if my break even is at 71 and the stock's sitting at 79, I'm not gonna do anything, right? I'm not gonna do anything until that I'm tested past that short put. Now, from that short put, all I'm going to do now is like, okay, now I have to manage it. Now I'm in the mode of, okay, reducing the risk, right? Because remember, when you put on a credit spread, it's already in your mind that it's defined risk. You satisfy with whatever happens. But now the thing is, if I'm picking up, I'm risking 2 to make that 1, I'm fine. So what I'm going to do is, if it reaches my short or my break even, I'm going to come to the call side and sell another $10 wide call credit spread to reduce it. So I'm turning it into an iron condor, or you can look at it as a strangle, or however you want to look at it, right? But you just got the wings. And then from there, I'm just going to manage it. I'm going to manage it. If I have to roll it out, to the next cycle. I'm going to roll it out to the next cycle. I'm going to buy back the put debit spread. Then I'm gonna add the call spread. I'm just treating you just it's no different. The only thing is that you got the wing for the defined risk. So
Right.
if Palantir go from 79 to 30, that's it. You know
you're in trouble.
exactly. But
But you would have been in trouble if it was a cash secure put anyway.
Exactly. Right. And then if you fall out and it does that, it's really going to eat you alive. Right. So I'm not being over aggressive. I'm just getting paid. So I know that, okay, per contract, I'm paying $640. Right. If I can reduce that $640 to $3, I may say, well, all right, I'm fine with taking that loss. You're right. Because I can get in and start over. Sometimes because sometimes it just don't work. But for me, I'm gonna keep fighting and fighting until I can at least have a small loss or break even. So
your strategy is to manage the spread by selling the other side, and so essentially it's like when I run the coverage triangle. On the shares, I sell the covered calls, I sell the cash secure puts with the same expiration dates. Two things can't be true: the cash secure put and the covered calls both can't be getting challenged at the same time. Exactly. It's either one or the other. So you're creating a coin flip situation that is for sure favorable to you on one side, and you're going to manage the other side.
And then if it keep going down, then I'm going to roll that.
You're going to follow it.
I'm going to roll it. You see what I'm saying? So I'm just reducing, my risk.
But in your strategy, I didn't hear you say, I'll just turn it into a regular cash secured put because you don't have any interest in owning these shares. So you're going to manage the spread until you can break even and get out of there, or you're going to win the trade. So you'd probably advise, not to put words in your mouth, but you'd probably advise doing these put credit spreads on something that you're pretty ultra bullish on, right?
Absolutely. You can do it. You can be bullish. You can see that it took a drop and you wanted to get in. Like, say, for instance, the way that NVIDIA dropped that day, right? And you're like, oh, Dad, what can I do to get in there and get some exposure, but not take on too much risk just in case it doesn't go my way? So I might do it in that sense. But for me, I do it in high price stocks though, right? Yeah. Like I'm not messing with the small stuff no more. I got killed, right?
Did you see my NVIDIA trade? I went to SOXL, and this is what he's talking about. Because look at the amount of risk that I took on, right? So I sold 400 cash secured puts on SOXL at $24 whenever NVIDIA tanked this ETF. So we're talking about tying up $960,000 to bring in, whatever I brought in, $80,000 or whatever. So options, like, well, I could have done that with, $300,000 in capital or something like that. If you would have done something on a put credit spread side of things. So essentially what you're teaching the audience here, and they may not realize that, and what you're teaching me, I want you to know, is that you have figured out a way how to make more with less from a percentage standpoint, because you know that you can always manage the other side.
Yeah. And the thing is, you don't, regardless of what, you don't want to be using too much capital, right? Because
that's why I'm exploring put credit spreads more, because it is very expensive to just keep selling cash secured puts.
And then we use margin, so we're using buying power, things of that nature. So as things go down, your buying power decreases.
Yeah.
But see, but that's where opportunity comes at when it goes down. So if I'm in a position where I'm just, cash secure put out, and now it's dropping, I don't have the margin, I don't have the buying power to take advantage of the opportunities anymore. Right? So now I have to wait and sit on my hands. But no, I'm not going to do that.
So let's talk about my favorite stock, because I'm really thinking that this is the one where I could do some put credit spreads. So we got Tesla here. Earnings are today. So I'm trying to build this position up to 5,000 shares. So I've got the 10 cash secured puts at 350. So this is again where options talking about, and you haven't said it, so I'm going to say it for you, that he thinks the cash secured puts are not capital efficient. Is that fair?
You said that
they are not capital efficient. You're tying up way too much capital for the amount of money that they pay.
Yeah, exactly.
Yeah, because I hear tied up $350,000 for 2 weeks and they paid me a whopping 4,466. So after having this conversation with you, like I almost feel like I got to close this out of principle because it's okay to laugh, option. Let it out, bro. You'll feel better. It's okay.
Don't get me wrong. It's a good trade, right? But
well, it's a good trade because I want to own the shares. But what you're saying is, if you're going to trade options, why don't you just risk less and make more? That way, your ROI on your capital is a lot higher at the end of the day.
And you're not, your risk it's defined.
Yeah.
Right. Because them the ones that, we stay around longer when you define that risk, because we don't know. We can't act like we know what's going to happen in the market. We don't know. Right. Yeah. We don't know. So my thing is, man, if I just got to throw a wing on it to cap it and define it, then why not give up $1? Right. You see what I'm saying?
No, I get it. And I think that this person does make a valid point. With credit spreads, you really have to manage the number of trades you have open. Otherwise, you can blow up your account very quickly. The market takes a dump. So I think that you got to realize the amount of money that you're working with. But I think the other side of that coin option is you got to realize the amount of knowledge that you're working with.
Yeah.
See, your knowledge is a form of capital. I always call it financial capital versus mind capital. Mm-hmm. So the people that have the most money and the most knowledge are the ones that make the most money if y'all haven't figured that out. Mm-hmm. There's people that have less money but a lot of knowledge and they do okay. There's people that have a lot of money and little knowledge and they don't do well either. Mm-hmm. So the idea is you want to try to get to the point where you have a lot of money and a lot of knowledge. Both types of capitals meet and you're going to make a fortune in the market. But in the meantime, while you're on the come up and you just can't, just put thousands and thousands or millions of dollars into your account, well, you can put that in the bank up here. And you can grow a smaller account when you throw enough knowledge and skill at this thing as well, because you're able to take on more risk than the average Joe because you know how to manage that risk and you can protect your account from blowing up. Because option before you learned.
In all honesty, even if I had,
how many accounts did you blow up? Did you
I never blew up an account.
Dude, and I am here to tell you guys that I've never blown up an account.
Yeah,
because I played small when my mind capital was small. This is whenever I talked about just being when I turned into TJ the Wheel Deal. I played small because I felt like I didn't have enough knowledge, and then I was trading these silly stocks that it was just about the PS, and there was no earnings to speak of. A lot of these were pre-revenue stocks and all that shit. And when I made the flip to deal with profitable companies or companies that had a clear path of profitability, etc., at least have 70% of that in the portfolio. And then I just became a student of the game. And now I'm going on my 5th year full-time doing it. So now my mind capital is a lot higher. The financial capital is high. So now I position myself to win and win in a really big way, but I didn't play too big too early. And I think that there's a lot of people that might be looking at the stream and y'all are sitting on a lot of capital. So you're feeling really cocky. I want to tell you to pump the brakes a little bit and make sure that the mind capital matches the balance, because if not, you're going to be the guy that lost a lot of money in the stock market over long periods of time.
And I say, even if I had a huge account, I would still be doing the same thing.
Sure, because it just makes sense.
It just makes sense. Why am I going to take unlimited risk?
Right.
For something that I can have.
So why me throw a put credit spread here on Tesla? How would you be playing this bad boy right here?
Okay.
And so they have earnings today after the bell. So now Ivy's going to be through.
I'm in Tesla, right? I'm in Tesla. So this is what I did. I went to the 51-day.
So move average. So
yeah, but it's a little bit different, right? I'm just doing, because remember, it all comes down to deltas. So if I want, with Tesla, I want to be long all year. Like that's this position I'm going to play all year and stay long in Tesla all year. I tell everybody, you just need to stay long Tesla all year. Gotcha. So for me, what I do is I start at the 51-day and I'm going, now this is on the call side first. I'm going to go to the 325.
Sell call?
Buy call.
Okay, buy call. Okay.
And I'm going to sell.
So you're buying the call, which one? The 325?
Uh-huh.
Okay.
And I'm going to sell the 325 short put. Right now, it's all about delta, right? So
Sure.
now
So
with
walk them through that trade right there. So you bought a call and you sold a put for the exact same strike, the exact same expiration date. So just right there alone, what is that trade called, and what is the logic behind it?
it's just synthetic. It's a synthetic 100 shares.
Okay.
It's like buying 100 shares because remember, puts a call, calls a puts, right?
Right.
That's what they are, right? But you can create 100 shares because see, everything is about the deltas that you get, right? So if you look at the delta on that position, it is 98
or 99. Yeah.
That's almost 100 deltas.
Right.
So I'm getting the same exposure for 100 shares of Tesla without paying 39,000. I'm paying 16.
Yeah.
Right.
Well,
But
right here we stopped. It says your total cost is only $68.
Exactly. So what I'm gonna do, what I also did was, then I want to reduce the capital, right?
Okay.
So I'm gonna buy the 320.
Call or put.
Put.
Okay. So you bought some
I'm
insurance.
gonna give up a little bit of delta.
Okay. There we go.
And I'm gonna buy that. So
Okay.
now I'm sitting with what? 82 deltas.
Yeah.
I got 82 deltas. Now I'm only paying
99%.
$8,000.
Mm-hmm.
Right? And you can multiply that by however many contracts you got.
Yeah, but we're not there yet because you got to put the trade together before you can put the amount of contract.
Yeah,
but that what we done is you bought a call, you sold the put for the same expiry, which is 325 or 321 strike. I'm sorry, 325 strike, 321 expiry, and then you bought some insurance. You bought a put, 321 expiry, 320. So you've got a $5 spread going on here so far.
Mm-hmm.
Okay.
So now all I'm doing is, remember my deltas. I have 70. I have 82 deltas to play with, right? Man, I can go to the shorter dated cycle and sell a call against those 82 deltas, right? To generate income. I can sell a call if you want to. You can come and sell the 425 call if you wanted to do that. But me.
So what you're saying, I feel like we're losing. Did I lose option? I feel like we're losing some people here with this knowledge. So essentially what he's doing is is a more capital efficient way as opposed to just buying like a leap, because that's going to cost you a lot more money. So he's essentially creating that in a different way. Let me put the thing over here. Copy. That way he can find it in case if he gets back on here. And then he can sell cover calls against it to bring some premiums through the door. So hopefully Option will be able to come back on, because I think we lost him a little bit. And I don't want to, steal his thunder or whatever. Yeah. Okay. So Option, I was just talking to the audience, and basically what you're doing is you're using a lot of creative financing, if you will. Instead of just like buying the leap and selling calls against that leap, you're approaching it a different way so that it takes more mind capital, but less financial capital, and you can essentially accomplish the same thing, because now you created an instrument with this three-legged dog so far, right? that you can now start selling calls against this thing and bring some revenue through the door.
See, the thing is, and it's about being able to, like, even if you have a lot of capital, you don't have to put up that much capital to get the same exposure.
Yeah.
That's the key. So I'm not going to buy Leap 365 days out. I'm just not going to do that. Because for one, I'm going to pay too much.
Yeah.
When I can come pay less in the 51 day, right? And if it go up, I just roll it to the next cycle.
Yeah.
I'm not using it. It doesn't make sense to me to use all that money. Yeah. It just doesn't,
So this person is saying, and I used to feel the same way when we would do these episodes. This is going over my head just a little bit. So can you walk them through the mindset in layman's terms and be like, okay, this is exactly what I'm trying to do with Tesla, and then we'll walk them through the trade again.
All
Because
right.
I think there's a lot of gold here for people, but we gotta dumb it down a little bit. You follow
I
me?
mean, see, the thing is that we can't do that, right?
You're right.
I'm just gonna be honest. You can't dumb it down.
But you're gonna have to learn how to multiply and divide. But in order to do that, you got to learn how to add and subtract first. Is what
You know, but what you have to do, right, is just understand basic, the basics. Calls or puts or calls. You can do whatever you want to do. But
Yeah.
I look at it from a perspective of I want to generate deltas, right? Because we all know the understanding of that. For every dollar go up, you make X, Y, and Z. For every
and what he's saying, guys, is when you own 100, when you own a share of a stock, that is 100 delta.
Yeah.
So you're trying to simulate owning shares without having to pay the full price of that share.
Exactly.
That's your game in a nutshell, yes or no?
That's the game in a nutshell.
Or you're trying to control 100 shares for the least amount of money.
Synthetically.
Yeah.
Right? And you can do that with options. So
I think we just elaborated on deltas. Delta is for, let's say you own one share of Tesla, and Tesla goes up $1. You are going to either make that dollar or lose that dollar. If Tesla goes up $1, you made $1 because you own a share of Tesla. If Tesla goes down $1, you're down $1 with Tesla. You're dancing in unison with that stock when you have a share of that stock, because that's a 100 delta. So what option does is he knows that you can buy calls and buy puts, and you can sell calls and sell puts. So if you can create the illusion of owning those shares, you're able to be like a shadow, because the share ownership is dancing with the stock. But if you position your deltas accordingly with the calls and the puts, it's like you're the shadow, and the shadow is going to mimic that, right? The shadow is going to mirror that, but you are not having to pay full price of admission. I'm just giving them a roundabout way of your mindset.
Absolutely. And that's what it is.
Am I on point? Am I on point with that synopsis?
Absolutely. And your platform tells you where your deltas are. So if you're looking at it, okay, that's an 80 delta. If I sell less, I'm getting 20 deltas. That's 100 delta, right? So you know where you at. It's not hard to figure out. Just, okay, this is the delta. This is where I want to be. But we know that delta is risk.
Yes.
Right? Yes. So you have to be comfortable with what risks you want to take based off of your deltas. So if I'm long Tesla all year, and I know regardless of the fact I'm going to be long, I want to get as close to 100 deltas as possible.
Right.
But I don't want to.
So now let's walk them through this trade again, and walk them. So I'm going to be executing the trade as you tell me, and I just want you to walk them through the mindset of everything that we're doing here.
Okay.
So first thing that you did is you wanted to buy a call in the 51-day cycle, correct?
Yep. I bought the call, which is I'm going to my 80 delta.
325, right?
That's your 80 delta, 80, 81
so
delta.
Right there. So you're at an 82 delta. So let's keep that in mind, because I think this is the part that we didn't do earlier. We just pushed the buttons. So you're like, okay, well, essentially what I'm doing there is I'm buying a deep in the money call, because the deeper that you buy the call in the money, the more it's going to shadow the ownership of those shares.
100 shares, correct.
So if you were to buy, let's say the 275 as an example, if you were to buy that 275, now you're probably approaching that 90 delta. If you were to buy the 250, well, hell, you might as well buy the shares. You're at 96. You follow me? If you go 225, now you're at 97. If you go over here to 180, well, now it's looking like 98. And eventually, if you go so deep in the money, it's just about the equivalent. Y'all see 99 delta. It's just about the equivalent of owning the shares. And that is what option is talking about. But now you look, the deeper that you go in the money, the more expensive the premium is. Because if you want to own the shares, let's just be logical for a second. I'm giving you guys some gold right now, and option can help me out. I appreciate you for helping me, dude. The deeper you go in the money, the more it looks like it is mirroring the ownership of stock. it stands to reason that that should cost you more money because the share itself is going to cost you $391 right now.
Mm-hmm.
So if you want to control that share, right, or in this case, 100 shares, it stands to reason that it's going to emulate what you would have to pay to just own the shares outright. But it's still cheaper because over here it's $268. If you wanted to buy the shares outright, you got to pony up what for 100 shares? 39 grand, 39,100, right?
Mm-hmm.
Here, it would allow you to control for almost 100 delta. It would allow you to control those same 100 shares for 26,800. So already there's a savings of about $12,000 or $13,000 there. So that's why options buyers and sellers exist, because they understand delta. They're like, why in the hell am I going to pay full price of admission when it's not about owning the shares? And
it's just about getting the exposure.
This is y'all's gold right here.
Mm-hmm.
It's not about owning the shares. It's about controlling the shares.
Mm-hmm.
It is about your exposure to that delta versus having to tie up your bankroll. That is where you live. This is the playground where you play. Fair enough?
Exactly. And it makes sense because now I have more capital to do other things. I have more capital on the side, right?
Yeah.
And if it tanks, I know what my loss is.
Right. It's a defined risk strategy.
I don't have to worry about too much. So just like, okay, so we was at the 81 delta, so we can stay on track, and we bought the 325.
Yes. So then
I came right across.
Now we're going to go back over here. So we're going to go back over here. I was just trying to give them the whole thing, right? Just to really, because I feel like we're losing a lot of people, but I'm trying to make this discussion a lot more viable for you guys that might be a little bit newer, because this is a much more advanced strategy, if you will. Fair enough, option? Mm-hmm. This isn't elementary level options right now. So you bought the 325 because you wanted to control the 100 shares of Tesla. Mm-hmm. And you wanted to mirror 82% ownership of those 100 shares, and you're willing to pay right now $7,700. If the trade, if we just left it alone, it's important for everybody to know that right now we would be out $7,700, give or take. Fair enough?
Yeah.
But okay, now what did you do after that, and why?
But the next thing you have to look at with that is, remember, you buying. Right. So if you're buying, now you have to make up that intrinsic value. Right.
Right. So now you got to find your rebate. Where's your rebate? Yeah. Just to keep it in layman's terms. Where's your rebate?
Now, what I'm going to do is sell the 325. Right. So
now you're going to sell a call.
Sell a put.
Sell a put. Okay.
Mm-hmm. Now, if you look at your little chart.
Before you do that, 325, hold on. At 325.
Hold up. Don't do it right yet. And
no, we're not. But we're showing them that it's a 16 or 17 delta. That is not a coincidence. Why? Because whenever you buy a call and sell a put for the same strike and same expiration date, it stands to reason that should equal 100. Mm-hmm. Because now that is what 100 shares would look like. Right. At some point, you got to be able to get to that 100 if you want to be synthetic. Right.
Exactly.
Because a lot of people use this terminology, but they never fucking explain it. That's why I'm like, dude, you sound smart in your own head, but you ain't making any sense because you're not explaining shit. Mm-hmm. You're talking a lot. You ain't saying shit. Mm-hmm. So I'm trying to, like, if we're going to have these conversations, and then when I say dumb it down means if you can't explain it to a level that a third grader can understand it, it's because you don't understand it well enough yourself.
Well, like, I'm not going to necessarily.
No, but I'm not talking about you. I'm talking about when I listen to other channels and they want to use all this fancy jargon that nobody understands, but they want to sound smart. So I'm just telling y'all that this shit is not that complicated. We're going to buy calls, buy puts, sell calls, sell puts, because option, that's the only thing that you can do with option.
Yeah.
You know what I mean? But there's a reason people are doing it, is what I'm saying. So the reason that you're doing it is because it's just a lot more capital efficient. and you don't want to have to deploy all of your capital. You want to make sure that you always have enough money on the sideline so you can really save it for a rainy day in case the market gives you those opportunities down the road.
And then, but just to add on to the dumb it down thing, though, to be totally honest, and it's not something I came up with, right? You know, it's something that Tom Sosnoff, that's what he
Right,
teaches.
tasty trade guy.
He don't dumb down. And what it means by that is this. Man, you just got to put in the effort, right? You have to
put in the work. Got to put in the work,
right? So I'm gonna get you there, but if you don't put in a little effort, then you're gonna follow this trade, follow that trade, follow this, follow that. Then you won't become creative, right? Because that's the objective, is to become creative, right? So that's why, you know, and I just follow what I've been taught. But in this instance, you see your little risk graph over here to the side?
Yes, sir. I see all the red over here to the left and the green to the right.
If you look at that kind of, you know, that can kind of help people as well, you know. But like I said, what I'm going to do now, I will sell that 325, and that's going to, you know, emulate that 100 deltas that I'm looking for. And that's how, and once you do that, what's your cost?
So now you're going to sell
the 325.
Well, we already did that one. I feel like I screwed this whole trade up again because I was playing with the dog. Give me a second. So we're gonna go sell options, and the first thing you did is you bought a call, 51-day cycle.
51-day cycle.
51-day cycle. You bought the call at 325, is 82 delta, right?
Mm-hmm.
And then the next thing that you did is you sold the put, right?
Mm-hmm.
You sold the put for the same delta, same the same strike, same expiration date. So you sold this guy right here, correct?
Mm-hmm.
And then what did you do after that?
Now, where does that put us?
No. What did you do after that, and why did you do it?
Okay, so first and foremost, that gives me my close to 100 deltas, right?
Right.
But how are you paying for that? I'm paying 16. You paying like 16,000 and some change for that 100 deltas, right? What I choose to do is like, okay, well, let me define that, right? By buying the long put, what's going to happen? It's going to reduce my delta to 80, 82, which I'm fine with. Because remember, I sold the 80 delta at first, right? So I'm going to reduce that back to the 82 delta. And now I'm paying less. And I still have my 82 deltas with defined risk. And I kind of, you know, I have it structured to where I can ride this on out.
So you bought the long call at 325, the 82 delta.
Mm-hmm.
You sold the put at 325, which was about a 17 delta. So that's your 100.
Mm-hmm.
And then you bought some insurance on top of that, and you bought the 320 put, all for the same expiry.
Mm-hmm.
And that was also a 15 delta.
So when I buy that, I go from spending 16,000 to spending 8,000. So
7,500.
It basically cuts it in half.
Yeah.
And I still have my 72 deltas.
Right.
But you know what I'm going to do now, I can come, all right, I'm going to sell, you know, I can sell a call. If the market goes down, I'm going to make money from the short.
So right now you could just be done with this and put the trade on, and then you can wait for Tesla to pump and then start selling calls against it, or you can start selling calls right away because you want to ring the cash register, right? You have that option at this point.
Yeah. And remember with Tesla, the skew is to the upside, right? So that means the calls are going to be more expensive. Yeah. So selling calls in Tesla in a weekly or a monthly, like say for instance, you go to the 23-day, you can come down to the 460 and sell that 20 delta.
And this is what he's talking about, guys. That's a 20 delta. So if you ring the cash register here, so now you just reduced your capital outlay from 7,500 to 6,700.
And now I got on a what's that? A covered call almost. That I'm gonna just, if it doesn't hit there, I'm gonna roll it to the next cycle. So I'm reducing the cost of that debit, right? Because we're paying the debit. And I'm just gonna keep reducing that till I get to the 51 day. And then what am I gonna do? I'm gonna take that whole position as it roll up and just roll it to the next cycle, the next 51 days.
So keep in mind, though, on Robinhood, this is where having a junior broker, if you will, can make your life a little bit more complicated because you're on the Tasty Trade platform, correct?
Mm-hmm.
On Tasty Trade, because Tom Sosnoff, is that how you say his last name?
Yeah.
It's what he does. They call him the godfather of options for a reason, right? Because the guy really knows his shit.
Mm-hmm.
And he created a platform that was designed by a premium seller for premium sellers, right? Like he created a platform for someone who lives and breathes options so that they could do things with just clicking buttons. So you could probably roll yours to the next cycle a lot faster than you can on Robinhood.
Mm-hmm.
On Robinhood, you're going to have to probably go back and, if you bought to open, well, you're going to have to sell to close, right? If you sold to open, you're going to have to buy to close.
Yeah, I mean,
but you're going to have to do like a 4-legged roll, kind of like on a put credit spread. It's a little bit of a hassle. Whereas on your situation, you just roll and you could just wait for the fill, right? Because we also got to talk about the gimmies and the gotchas. The bid ask spread is a lot wider when you're dealing with spreads versus just on a regular cash secured put. If there's high liquidity, high open interest, high volume, you're literally talking a penny, 5 at the most, right?
Yeah, and if you
here
stay in the monthlies,
it's different.
You have to stay in the monthlies as well. If you got to get out the weeklies, if you're in the weeklies, that's another issue with the wide bid and ask spread.
So now that we have the entire trade there option, let's just summarize it because we'll leave it on the channel and there's a lot of gold here if you guys are willing to watch this a couple of times for it all sink in. So we have here buy to open the 321 long call, 325 strike. You sold to open the put, and then you bought to open a long put, bought some insurance there. And then you're like, well, let me ring the cash register because now I'm synthetic on this bad boy. So now I can, and I didn't have to put all of this money for the leaps. So now I can sell short calls against this position so I can try to bring some money through the door. That way my capital outlay is less. So that's essentially what you've done. So now walk us through the mindset of what are you cheering for? Because I remember when we first started doing these things and I was just like, dude, I'm at the casino. I'm going to sell puts. I'm going to sell calls. I'm going to collect premium. And then you had me in this freaking jade lizard labradoodle bullshit, like zebra and all this other crazy shit that Tasty Trades does. And then I'm like, I don't even know what team I'm on right now, yo. So I'd have to go back and watch these. This is like 2 years ago. Roll the tape. It's on there. I have to go back and watch them and understand where the hell your mind was at because you were a lot more advanced than I was at the time. So what did I do? I had to go put in the work. So I'm like, okay, I got cash secure puts down. I can roll those when it makes dollars and cents. I got cover calls down. I can roll those when it makes dollars and cents. And I already knew how to buy leaps because that's where I started.
Correct. So
I'm like, okay, I got those three tools, right? We're going to a war, and that's what's in my tool chest. That's what's in my war chest right now. So I'm like, well, now let me figure out how can I do it if I didn't have all this money at my disposal? How can I still get some pretty big returns? In other words, how can I play big when I'm small in the market, so to speak? And that's when I'm like, I started learning about all this stuff. So now walk us through it. What are we cheering for? What's the best that can happen? And what's the worst that can happen?
Okay. Well, the first thing is that position is nothing but a covered call, right? It's a covered call, right? Where you got your shares and then you sold you defined it by selling the call against it. If it continue to goes up, then the amount of money is capped, right? So it's a covered call, right? You have no risk to the upside. Your risk is on the downside, right? So I'm controlling.
Real quick option here. Why 16K? Because if all you did was buy leaps and then started running the 4-man cover call, you would be out about $16,000 versus doing it your way. You're out about $6,000 or $7,000.
And then it's like I said, if you go out and buy that leap, you got to make up that intrinsic value, right? Yeah. You have to make that up, right? So you losing a lot of theta a day. You see what I'm saying? Yeah. See, this trade I got is positive theta. Mm-hmm. If you buy just that call, it's negative theta. You're losing money every day. So see, it's not just one thing. You have to look at it as a whole. What you want positive theta trades. So therefore, you make a couple of adjustments, you can turn it into a positive theta trade, right? So that's why I don't just do the leap, because I want positive theta. All right, so
what are we cheering for? What team are we on right now?
It's a covered call. It's a covered call.
What you want, guys, is you don't want a world where Tesla's over $460 a share on February the 21st.
Exactly.
In a nutshell.
You can generate that. How much was it? Six and some change? I forgot exactly how much it was we took in.
On the 460? On the 460 call?
Yeah, the 460, that's $715.
Yeah, right here, $700.
Yeah, so you're going to generate that, then you're going to roll it out. So you're going to roll it out, expand it. Not only are you rolling it out, you reducing your cost basis of the trade.
So help us out though, option, for those of us that haven't put in all the time for school. Mm-hmm. How can you continue to roll out that covered call? Because I feel like it wouldn't allow you to roll further than 321, because that's where the buck stops, right? Whereas when you buy the leap, you've bought more cycles. Here, you only bought a few cycles that you can work with. So walk us through that right there.
So what I'm going to do is, let's say, for instance, it gets to 25 days or 30 days. I'm just going to roll my 51-day position to the next cycle.
So everything that you did for 321, you're going to do it for like 421 or 521.
Exactly.
And that way you can just keep inching it along.
Exactly. And the covered call will the call that I'm selling will continue to follow.
So essentially what you're doing in a nutshell is you're doing like a 1 year same as cash on the leap versus paying for it all outright. You're doing monthlies, because if you like it, you'll keep doing it. If not, well, then you can close out the position, probably get 80 or 90% of the money that you paid for it. And then what was your profit? The call premiums.
Exactly. And I'm only paying $7,000 for that position.
Yeah.
If I go by the leap, you already know they're going to overcharge you, right?
Yeah.
I mean, that's how life is, right? You're going to overpay for it. And then you need movement to move your way. I'm not doing that. I'm not doing it.
So guys, again, this is designed. What he's talking about here is the trade where you're really bullish on the underlying. This is just another way of doing it versus like, well, I'm just going to go buy the shares because I got money. I'm just going to go buy a deep in the money leap because I got the money. This is another way to play with the big boys, but be more capital efficient by throwing more mind capital at this trade.
And then you got to be careful when you buy that, because remember, because really it's nothing but a diagonal spread. I mean, pretty much. We call it a poor man covered call, a poor man long leap. Right. It's nothing but a diagonal
terminology for the same shit. Yeah.
Right. But the thing is with that is when you create that diagonal spread, most people will go out and buy that long put or long call further out in time and then immediately start or just go sell calls against it. But what you're doing is you got to understand what the width of that spread is, because you automatically, most of the time, are locking in a loss because of how much you paid for the long call.
Right.
So even if the stock go up, you forced to have to continue to roll instead of saying, well, you know what? I think it done went up enough. I'm cool with it. Let me take my profits and go. You can't do that, because that short call that you selling in a closer dated cycle you're not getting paid enough to be able to not lock in a loss. In this instance, It doesn't even matter if the stock went past 460. I'm still going to be profitable. So I have no risk to the upside.
Right. Option, you've given people a lot to think about. And I think there's two schools of thought when we get to these points.
Yeah.
Is one, it's not for me. I'm glad I have the capital. I can just sell cash secure puts, cover calls, and roll when it makes dollars and cents. You can keep doing that, and that's fine. I do it too. I do it too. But if you're ever in a situation to where you just don't have that kind of capital at your disposal, then you're forced to learn another way to navigate these waters if you want to generate big boy income, right? Because what you're saying is you can throw a lot of mind capital at this thing and you can still generate pretty crazy returns if you're willing to just go to school a little bit.
But I mean, it's not just that, right?
Yeah.
It's risk, right?
Yeah.
That's what it comes down to. So it doesn't matter the capital, right? Because if let's say you do it one way and you just sell cash secure puts, if you get that drop, and we look at it from a standard deviation, because
it's the same as owning the shares. You're screwed,
right?
Yeah.
Not only are you screwed, right?
Yeah.
But if you're using buying power or margin, right?
Yeah, I'm in trouble.
You're losing that. So you're not given the opportunity to take advantage of moments of high implied volatility, right? When the VIX done jump to 40, because you got all your capital tied up. But if you can create that same thing without tying up all of your capital, make the same money, and then when the market drop, you can jump in and take advantage of these opportunities. That's where I'd rather be. So it's not a capital thing. It's just the risk of knowing how these things, how it works, right? Because it's just that way. I mean, that's, it's just that way for me. And that's how I look at it, right? Why not be able to, if I can create the same position for cheaper, why not do that?
Right. No, and I think that is where I wanted to improve my game, because I look at selling options as like an NBA player or a football player or whatever, and you're always trying to get better in the off season, right? Mm-hmm. So for me, every year, the start of the new year, it's like, okay, like what did I improve from last year, and what wrinkle do I want to add this year? And this year to me is I just wanted to become a little more capital efficient.
Yeah.
It's like, if I'm going to put these dollars at risk, like I want to make sure that the deck's tilted in my favor a little bit. You know what I'm saying? Like I want to stack the deck in my favor just a little bit more and be more precise when I fire the bullets. I'm still not your traditional wheeler from the standpoint that I feel like at the end of the day, I'm who I am. I'm a buy, hold, and hope investor who essentially masquerades as someone who sells puts and calls. Because I sell puts and calls on my favorite underlyings because I'm trying to lower the adjusted cost basis to zero. But if I didn't own any shares, there's nothing to lower the adjusted cost basis on, right? Like, so that's the game that I'm playing for the long term, because eventually I want to be able to walk away from the portfolio, and I want the portfolio to do its thing. I'll be like, hey, y'all remember when I wheeled options for 5 or 10 years on YouTube? And now those shares of Tesla are doing their thing. Every once in a while, I log in just for shits and grins, and I sell cover calls against them. You know what I'm saying? Just to get the juices flowing, to make sure that I still can. That kind of thing.
But you know what? I think I kind of understand it. It's like, we think that if we don't own the shares, we're not doing the same thing, right?
Yeah.
We're doing the same thing, right? You don't have to necessarily own the shares.
You created 100 Delta.
You don't have to own the shares to do the same thing. You're not losing no more. You're not making no less. I mean, it's the same thing. Or if the stock go against you, all you got to do is roll it.
Yeah.
All you got to do is roll it. Right.
Correct.
All you got to do is roll it.
And there's a lot of truth to what you're saying. The reason that I choose to own shares is because that's the only thing that I don't have to manage, right? Mm-hmm. Like eventually I want to not have to do anything, right? The wife's like, hey, we're going to take 3 to 6 months off. You don't manage the 401k. You know what I'm saying? You don't manage the IRA. You don't do shit, right? Because it's going to do what it's going to do. And that's why eventually, whenever I look at all of these options right here, Eventually, those options are all going to expire. Eventually, all of those options are going to expire. And I've got a lot of them expiring here. A lot. Check it out. Got a lot of them expiring. A lot of them expiring by the end of February. And then if you look at the end of February, there's few for March and only one for April. And then it starts this crazy cycle for January of 2026, a little bit June of 2026, and a little bit January of 2027, because I'm trying to position my life to where I literally just trade the account 6 times a week, 6 times a year, if that makes sense. Because I'm already practicing the mindset. I'm conditioning the mindset. So the question, the obvious question is why, right?
Mm-hmm.
So the reason is because I'm raising a lot of money for a hedge fund, and it's going to require all of my time at some point.
Definitely.
So I'm positioning the portfolio to essentially be on automatic pilot, if you will, where I could look at it and glance at it in 30 or 45 seconds once a month and know something like, okay, like I'm going to have to push a button over there, but I'll get to you.
Yeah.
Because it's such a small percentage of what I am going to have going on here in the next 6 to 12 months.
Correct.
So that is why you're starting to see it, right? Like I'm showing it to y'all in real time that I'm scaling out of having, 10 or 15 cover calls or cash secured puts that are expiring on any given Friday, because I just am not going to have time for that anymore.
Yeah.
Because my focus has to be over here on something that can make me a lot more money than what I can generate with the portfolio, if that makes
Correct.
sense.
And I know for me, like I told you, my worst trade ever was in Mara, right? And I learned a lot.
Hold on. Virtual hug. Okay.
Listen, I'm still not back off of that trade, but that made me change, what I like to do. And I'm like, I have to be in higher price stocks, right? So with that, even like if you take this position, and I'm fearful, right? Because I don't know what's going to happen. So I have to protect myself against a down move. Remember, Tesla was 400 or 500 and went to $100.
Yeah,
right?
yeah.
So see, I'd rather
414. Like 106.
I'd rather be trading Tesla the way that I'm doing, risking $7,000. Because just think about it. Let's say I own Tesla. I bought it for 30,000, right? Tesla now drops to 100.
Mm-hmm.
I'm only out of $7,000. And you know what I can do? I can still turn around and get another 100 shares. Right. And I only paid $17,000, and I'm starting from there. Right. In opposed to I need Tesla to come back, or I gotta sell, calls over, under my cost basis and have to, so that's just my thought in, how I like to navigate it, right? Because risk is risk, man. And like you said, if you get too cocky, they're gonna get you.
The market will humble you very, very quickly.
Because we understand the standard deviation, right? We understand how that works, right? Those tails, they exist, and they there for a reason. Let's not act like they don't exist. So if you don't kind of strategize around it, then, and so like even when I'm in a bad position, it doesn't bother me because I already know, like, okay, if this does that, then I'm going to do this. If this does that, then I'm going to do this. So
absolutely. Well, my man, I appreciate you. You've shared a lot of valuable nuggets for us. I believe we are having Wheelers tonight, guys. If you want to tune in at 8:00 Central Time, Texas time, and we're going to go over all things put credit spreads from 3 or 4 perspectives. I know you're busy with the family and stuff, Auction, but if you are available to click the link, my man, we could use you. And then we're going to talk about my specialty in the market, which is the backstop trade. Like I have built,
you can't beat that leverage.
I have built my entire, 50, 60% of my gains are because I'll sell these out of the money leaps and I'll go super, super heavy.
Remember, you said sell. Said sell.
Yeah. I sell cash secured puts year and a half in the distance. and a shitload of contracts, and I get all of that money, and I sell short dated cycles, and then I'm compounding that premium, and I look up 12 to 15, 18 months, and I'm like, shit, on that $1 million, I just made 30 or 40%.
Yeah, I mean,
And it works for me. And again, I think that the one thing that Optionist showed y'all today is that he has carved out his niche in the market, and that is really, really important because it took me a year or so to decide, hey, selling puts and calls fits my eye. It's like a golf shot.
mm-hmm.
And then, but now I want to add a little bit more because some market conditions require different knowledge and different strategies. And I don't want to just be like, oh, well, whenever it's a bull market or if it's flat, my strategy is working great. I want to have more tools in the arsenal, different ways to cash grab whenever the market's going down as well. Because 2022 was great because the premiums helped me to have a flat year.
Mm-hmm.
Had it not been for the premiums, I would have had a horrible year in 2022. But the premiums offset what I was down on the shares, and then 2023 and 2024, I'm looking like a god, an options god, because I had owned all those shares and I still collected similar premiums to what I did on that year where the shares were down, right, in 2022. And then last year was a banner year because all the work that I put in 2022, it came to pass in 2024, and you have this huge S curve in the chart for the portfolio. But anyway, man, I got to run, man. I appreciate you so much. Option, we'll do this again, brother. TJ the Will Deal signing off as always. May your sky stay blue, stock screen. Peace out. God bless you guys.
Peace.